Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and Simon Lambert today is Lee Boyce. And coming up, can your bank really close your account because of your political views? What a coincidence. Big banks hike savings rates on the same day that bosses face questions over paying savers fairly, to save or to invest. That is the question. One think tank is convinced we should be investing more. Are they right? And the little known trick that can slash your tax bills in retirement and boost your income. But there's a catch. Don't forget to stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.
But first, banks have come under fire this week for allegedly closing customers' bank accounts over their political views. Now, this is after Nigel Farage claimed his was shut due to his Brexit campaigning. Banks are even facing a Treasury investigation into claims they're closing accounts because they just don't like their customers' views on controversial topics. It's a murky business with a lack of transparency. For years, customers have been complaining of accounts being shut with no warning and no reason given. It's thanks to money laundering laws. So what can banks close your current account for? And what can you do about it? Lee, what's this all about?
Well, earlier in the week, there was this whole row that blew up where Nigel Farage said that he was no longer, or he's had his account closed from his current account provider. Now, allegedly, the current account provider in question is Coutts, and Coutts does have a seriously different set of rules for who it accepts as a banking customer in terms of how much capital you have. So typically, you need £1 million in your current account and or £3 million in savings. Now, that is a quite high amount for most people, but people know Coutts, Queen's Bank and all that, but part of RBS Group, NatWest and the rest of it. So it's one of those things in which it's very hard to decipher completely what's gone on here because I have seen this before. This is money in terms of people having their current accounts closed with little warning, basically banks hiding behind terms and conditions which they don't want to share with their customers or journalists alike. They shield themselves over a load of data protection rules, money laundering rules, all sorts of things at play that basically make it really difficult to actually find out what's going on. Now, my hunch is that for a lot of the bank account closures that we get emails in about, it would be because customers are doing things that the bank would claim are a bit dodgy, a bit iffy. So an example of that might be someone gets in touch with us, says their current account's being closed for no reason, but don't share the full details with us in terms of they might have been part of being a money mule, for example. And that's where a fraudster pays you a certain amount of money to use your bank account for a bit to transfer scam money into said account and then move it out quickly. That's a classic example. However, the real trouble with it all is that we never get told this is what's going on. It's always just a kind of blanket, we can't tell you what's going on. So it all gets a bit shrouded in mystery. The Nigel Farage one, the whole row is sort of blown up because he's claiming that his account's been closed because they simply don't like him and what he stands for and who he is. And that's where...
I mean, there's paranoia, Lee, and then there's paranoia, isn't there? I mean, is there any reason he has for thinking it's a political, personal thing? Because I thought one of the biggest problems with banks is the computer says no kind of blanket issue. This sounds very personal.
Well, it's very hard to know, isn't it? But without seeing all the ins and outs and discussions at high level with the bank, etc., very hard to really kind of decipher totally what's going on just over a kind of range of sort of angry tweets about the situation.
But you've never come across anything like this. I mean, you've come across bank accounts closing for lots of different reasons or for reasons not given, but you've never come across anything.
Nothing to do with political views or views of a certain person and what they're putting out on Twitter, but or social media in general. But there have been other sort of cases in which some people argue that they believe they've had their current accounts closed because of certain views and certain political views. But it's very hard to kind of prove. And to be honest, in this case with Nigel Farage, it makes it even more tricky because it's Coutts. And Coutts is very picky about who it chooses as a customer. It's a very high-end bank. I don't know the ins and outs of Nigel Farage's, finances. With full transparency, we've got absolutely no idea quite what's gone on. But what it means for the actual average person listening to this and the average person that's kind of cottoned onto this story is that banks do wield an awful lot of power. And you realise that if you do have your bank account closed for whatever reason and with little explanation, and banks hide behind all sorts of clauses that they've got in your terms and conditions. Have you read the terms and conditions of your current account? Did you read the terms and conditions of your current account when you opened your current account? I think the majority of people listening to this would say no, got absolutely no idea. And then banks will point out all sorts of strange clauses that are in your current account. Information saying that basically we can shut your account whenever we want. And sometimes banks will shut a current account if it's laying dormant. That's a classic example. But when it's someone's regular day-to-day account, what happens is that you almost become sort of blacklisted from having it.
Say, tell me, spell it out for me, Lee. What happens when you can't use your current account?
Well, it kind of can make you unbankable, because other banks look at, the questioning why you've had your bank account closed, then can't find out the reason why you've had your bank account closed, because they're hiding shrouded in mystery and sort of.
But will you get your payments in, your payments out? What you're in no man's land, financially speaking, are you not? You're in total no man's land. I mean, apparently there's 1 million people in this country that don't have a bank account. So from the Nigel Farages to people that are in this country and haven't been able to open a bank account because they don't have a permanent address, all that kind of thing. There's a huge argument here about the unbanked, and we've spoken about this before. It makes life incredibly difficult. It really does, and it's not until something like this happens to you that you realise you're in full panic mode. If you're given just days or weeks without an explanation that your current account is being closed, that is panic stations for anyone. It doesn't matter if you're Nigel Farage or someone on minimum wage. It's a scary world, because as I say, it makes it very hard, very tricky to get a current account afterwards. And the large reason for that is that banks are risk averse. So if they have any kind of reason to think that you've done something dodgy with your account, it then makes it very hard for another bank to sort of trust you to run your account. And often these blacklists last for 6 years. That's the typical time. 6 years potentially without a bank account. So you can see why Nigel Farage is upset. Allegedly, again, there's all sorts of. I've not spoken to the press office, so I don't know all of the ins and outs of this. I haven't been hugely involved in terms of Nigel Farage's case, but allegedly he was offered an account with NatWest as an alternative. Allegedly is what I sort of was reading on a story yesterday. But where the truth lies, I don't know. Without sitting down with a pint with Nigel Farage and a pint with the Coots press office, I've got no idea what's happened to Mr. Farage. But this happens to people, Georgie. We get a steady flow of people that have their current account shut from all sorts of different high street banks, and it is an absolute nightmare. So I mean, Simon Lee says there that he's experienced, or he's heard from a lot of readers that have gone through bank account closures. Now, I don't know what your readers are like, Simon. I'm pretty sure they're not many of them are money laundering money mules. So do we ever get to the bottom of why they're shut? What are the legitimate reasons that a bank can shut your account apart from really nefarious issues?
Well, I suppose the first thing to consider is that the reason why this has hit the headlines is the Nigel Farage question. Now, it suits Nigel Farage to claim that his bank account has been closed down because of his political views and his political stance, doesn't it? Now, Coots, insiders at Coots have said that it's because Coots requires its customers to borrow or invest at least 1 million with the bank or hold 3 million in savings. But speaking to the BBC, when they put it to him, Mr. Farage said he didn't dispute the fact that he had not met the Coots threshold, but added they didn't have a problem with it for the last 10 years. You can do that in your own Nigel Farage voice, right? But you can imagine exactly how he said that. Cigarette in one hand, pint in the other, in France, obviously, because, hey, Brexit. The thing is, it suits him to argue that this is, political persecution. Interestingly, Lawrence Fox piped up on this, unsurprisingly, at the weekend with someone asking him about his bank accounts, or about his mortgage. And he said, "You think they allow me a mortgage?" Now, when I read that, I thought, well, presumably that might be to do with the fact that do you actually have a job? Because that is a general requirement for it. And it seemed that Lawrence Fox had given up his job to go sound off on Twitter about stuff. Now, whether you think he's right or he's wrong, in order to have a mortgage, you need verifiable income. And I don't know, it looks a bit like someone who's shooting his verifiable income in the foot there. So it's quite murky when you get these instances. Now, most of the readers who come to us are not Nigel Farage or Lawrence Fox. Unfortunately, neither of them came to us first and asked us to step in and see if we could do something. It would have made a great crane on the case. But there is a line that runs through a lot of this, which is there's this kind of secrecy. There's this you're accused of a crime you're not allowed to know about vibe that goes on. Lots of the people who come to us say, I've just had my account frozen. I can't access it. They won't tell me what I'm meant to have done wrong. Now, when we put this to the banks, they, as Lee said, they hide behind data protection, they hide behind money laundering. They say, we can't even tell you what this person's done wrong, because if we tell you, you might tell them, and that might alert them. And if we alert them, then it might harm a police investigation and things like that. But it makes it very, very difficult to verify exactly what's going on here. Now, in some of those instances, people who have contacted us and said, my bank's shut my account, my bank's frozen my account, have probably done something wrong, okay? I've had calls from people, and I've spoken to them before, and I've thought, I reckon you might have got yourself involved in some money muling or something here, which is when they help fraudsters basically take money, put it into lots of different accounts, spread it through lots of different accounts, and they go out very quickly in a web, and it becomes very difficult to trace.
That's really common.
Yeah, it's been a big thing. There was warnings about basically saying, like, teenagers, students, don't get sucked into it. It sounds like easy money. It's like what or someone says, on the old Instagram, Facebook, Telegram, whatever, do you want to make some quick money? People see it as a victimless crime. They don't realise that possibly at the end of this is an old, a pensioner who's lost their life savings because they've been duped on the internet. And if they thought about that, then maybe they wouldn't do it. And it is a problem. But then you do wonder sometimes when you speak to people, some of them really do persevere and are absolutely adamant they haven't done anything wrong. You speak to the bank and they say, can't tell you exactly what it is, but, ask them whether they've done this, done that. You go back to them and they say, no, I honestly haven't done it. And there comes a point where, either someone is so unbelievably, stubbornly, belligerently adamant that they haven't done something that they've convinced themselves and they're doing an exceptionally good job of pulling the wool over our eyes, which I will allow that there is potentially a small percentage of people who do that. But then there's others who you think, I genuinely think they're probably telling the truth here, because I would have just given up. Because as a journalist, when you speak to these people, obviously you try to be supportive of people, but sometimes you do give them a hard time. You say, well, have you done this? Have you done that? Have you done that? And, your radar's normally pretty good for when someone's fibbing to you. And some of the people who call us up are not, or get in contact with us do not appear on the surface to be the most sophisticated or cunning of criminals. So, or comment. So there is, you do wonder about this. One, I think this is possibly the Farage thing has been blown slightly out of proportion. You can understand people's concerns because with the increased amount of digital banking, with talk of central bank digital currencies, with things like, we've seen what's happened in China with central bank digital currencies over there. There's all this conspiracy stuff we talked about the other week, but there are concerns about banks making decisions, and the payment providers and banks have done this to people in the past on a very large scale. It happened with the Canadian truckers protests during the COVID period. Basically, effectively had their assets frozen. Lots of people, their assets, their bank accounts frozen. It was weaponized and used against them. And that was political. It was politicized. We've seen it in other places as well. So, are they pinpointing people like Nigel Farage? You think that would be a bit daft. Because if there's one thing you say about Nigel Farage, is he's capable of making a very loud noise about stuff and drawing attention here. So if Coots and NatWest were pinpointing him, then it has spectacularly backfired. Now, he claims he can't get a bank account with other people. I don't know, we don't know the ins and outs of it. Unfortunately, as I said, he didn't come to us for a crane on the case. But, the thing that there is a question when you open a bank account that says, have you been refused a bank account or had it shut by anybody else? And if you tick that box, I reckon your chances of getting another one diminish quite a lot.
What do you do, Lee, then? What's the alternatives? What should you do?
Well, first, before I wade into that, my viewpoint is that anyone should be able to have a current account. And basically, it doesn't matter what your views are. At the end of the day, having a current account, it should just be a basic right. Now, having a Coots account is probably not a basic right, but just any standard of current account.
You're taking first world problems and then you're going up a notch there, aren't you? People's right to a Coots account.
Exactly. But if you look, listen, if this has happened to you, and as I say, I get a steady stream of these, don't, and especially if you have done nothing wrong. If you have done something where you hold up your hands and you have done money muling, you kind of got offered money you didn't realise what you were letting yourself in for. I mean, my first piece of advice would be, don't try and like fib and lie your way out of it. You've made a mistake, you've done it. What's going to happen from there, I'm not too sure. But there is hope if you are someone that's had their current account closed and you believe you are right. There's no reason why this has been closed. Because we had an email this week from someone. We're looking into the case details at the moment, so I won't reveal which bank it is, but saying that basically this happened to them. They had all of their current accounts frozen, personal and business. Now that's frightening to have personal, but to have personal and your business accounts frozen, that's that's another notch up, right? I mean, that's incredibly scary. But they said that they took it to the financial ombudsman. Financial ombudsman looked into the case, decided that the bank in question had no right to close the account, made them pay compensation and interest on that compensation and reinstate the accounts. So there is hope out there, and banks aren't always in the right. Banks have a lot of back-end operations in which they're always looking for fraud. They're always looking for money laundering. The ramping up of this in recent years has been vast. The amount of information and power they hold is huge, but that doesn't mean that they're always correct, and that something might have flagged incorrectly in the system somewhere. What I can't accept is that this bank in question, how would they not have reversed that decision? Why would it have needed to have gone to the ombudsman? So that's the kind of information that we're trying to find out at the moment. So the first thing to do is really try and establish with the bank what's gone on, and try not to panic too much, which is simple advice from someone who hasn't had their current account closed. But that's what you need to do. And if it really is unfair, you need to get a timeline, screenshot all of your statements, or get paper statements, or anything that you can get, all the information you can get, and then you're going to need to take it to the ombudsman and see what happens from there. But it's scary times, Georgie. I honestly, some of the emails that I've received from readers saying that they've had their account closed, I believe, often it's a coherent email. It's often, I read it and I think, that doesn't sound quite right. But whenever we take it to press offices, they hide behind all sorts of data protection, all sorts of, we can't tell you what's gone on. It's, basically we suspect criminal activity. And it gets very difficult. And it's scary. But if it has happened to you, do get in touch with us, editor@thisismoney.co.uk.
Right, we're going to stick with the banks, and what a coincidence. What a coincidence indeed. On the very same day that bosses faced a grilling over their treatment of savers, Lloyds and HSBC announced rate hikes on a number of their savings deals. Now, Lloyds and Halifax, which is part of the Lloyds banking group, upped rates across their fixed rate bond and ISA products by 0.5 percentage points, HSBC bumping them by 0.65%. At the end of this month, the FCA will introduce the consumer duty. That's a requirement for firms to always act in good faith and deliver fair value to their customers. Lee, you're going a bit red in the face and you're sort of mouthing along there. It all ties in.
It's just making me
fairly.
It's making me chuckle a little bit because I don't know, that sort of language is just sort of like, I don't know, banks are businesses. I just can't imagine. They're there to make profits. They're not there to serve the best interests of their customers. And that's just the lay of the land. That's not me defending banks. But when you start getting government meddling involved in any kind of sort of financial matters like this, it usually blows up and something mad happens.
Simon, this is what I can't understand is, as much as we would love the banks to follow on the Bank of England base rate, et cetera, because they're doing it with mortgages, they are ultimately businesses. Why is the FCA getting involved in this?
It's just been a real sort of bugbear. Harriet Baldwin, the MP, the Treasury Select Committee, has been hammering this home for the best part of this year. And you're right. I mean, the big argument is that mortgage rates are going up far faster than savings rates are going up. The way that savings rates are set is the fine balance between what they're lending out and what they're taking in from savers. Now, the big problem is banks are still holding on to billions of pounds of people's cash. And that's why challenger banks tend to offer better rates, because they're looking to attract the money in. So you might be a small challenger bank, you need to raise X amount of money, you need to go to the top of Best Buy tables because the general public don't know who you are. So you go in there for a couple of days, rake in the money you want, and then you pull the rate or someone else overtakes you. With banks, it's a completely different kind of philosophy. It's people legacy savings accounts dotted all over the place, people keeping their money in current accounts. Lots of people just want to keep their money parked in savings that are with their current accounts all under one roof. It's quite a complicated beast. And I think if you start telling banks where to set their savings rates, it's a bit of a dangerous precedent in my mind. Again, this is not me defending banks, and some of the banks are still offering 1 to 1.5 to 2% on savings rates. But if that's your money parked in that, people aren't actively opening these accounts. These are legacy accounts that people have got money in, and we have seen data from Bank of England in recent months suggesting people are pulling money out of the big banks at record rates. So people are moving their money around and looking for where they can get their 5-6%. I just thought it was very, very, very telling yesterday that HSBC and Lloyds both upped their savings rates on the same day as the FCA kind of grilling, another grilling from the Treasury Select Committee, and it just smacks of a kind of, have they just timed this to do it as almost like a middle finger, like up yours? We're launching rates here, because actually some of these rates are pretty good, Georgie. If I'm being quite frank, I think the Lloyds 1 year fixed rate cash ISA will pay 5.45%, and its 2 year cash ISA will pay 5.5%. The reason why that's a really good deal is because we won't go into down this massive rabbit hole again. But in terms of people's tax, I think people are having to utilise ISAs a lot more this year because of the personal savings allowance, where you can have £1,000 of interest. This is very broadly speaking, but £1,000 of interest if you're a basic rate taxpayer, £500 of interest if you're a high rate taxpayer. People are having to utilise their ISAs way more this year to not breach those amounts. And actually, at the moment, some of the banks are offering fairly okay rates. They're not groundbreaking, but they're not absolutely awful. This is their very best rates, though. You have to go and act, and you have to go and see. The other week, for example, I was on the hunt for a new savings account. I'm a First Direct customer. There was a savings rate that was actually semi-decent that they hadn't even advertised. I mean, that just sort of blew my mind. And we're living in this personal finance sphere. So all I would say is, if you're with a big bank, most of us are, I would say the vast majority of us have a current account with a big bank. Go and see what savings rates your bank's offering at the moment. Round up all of those pots doing absolutely nothing. There's no excuse. And if you're unhappy with your bank, just take the money out and go and have a look at our Best Buy tables. There's dozens of good accounts, big established names, all with FSCS protection, and just go for it. The onus sometimes has to be on the consumer. It can't always be on the big bad banks to do the right thing.
Yeah, absolutely. I mean, Simon, when Rishi halves inflation by the end of this year, those are looking even tastier, aren't they?
I'm not sure that Rishi's going to manage to halve inflation by the end of this year. I think, mathematically speaking, he thought he was onto a pretty surefire winner, but inflation might have another idea. Look, the rate panic's still going on. Fixed rate mortgages are still going up. The small banks especially are still chasing money by putting up their savings rates. This week we saw suggestions that the base rate might now go to 7%. That's an outlying scenario, though, by JP Morgan, which it says if inflation is much more stubborn and stickier than expected. Although that an outlying suggestion, because inflation so far has consistently managed to remain much more stubborn and stickier than expected. But its main suggestion was 5.75. The market is now saying 6.5, but the market is regularly wrong. I think everything's running ahead of itself at the moment. I said we were in peak panic 2 weeks ago. I never underestimate the ability of panic to peak a bit higher. But, it is complete madness. I don't think the base rate's going that high. I might be proved wrong. But there are some great savings deals out there at the moment. And you need to look at these and go, okay, well, if I put my money in an easy access account, I can always move it, right? That's the great thing about an easy access account. If a better one comes along, I can move it. If I put my money in a fix, then I'm locked in for a year. There are people who stuck their money in a 5% fix and thought they were getting a great deal, and now they're looking at 6% 1 year fixes and going, oh, drat, I should have waited. But you should also remember the opportunity cost of waiting. You're not earning that interest for, the time that you're waiting. And if you've got your money in a rubbish legacy account, then that opportunity cost is quite high. And also you need to look at the difference between the two rates in actual monetary terms. Unless you've got a huge amount of money to chuck in there, how much is it actually going to cost you to take a 1 year fix at 6% rather than say one rolls around at 6.5% soon? How much are you actually going to lose out over the course of a year? Because for many people, it won't be that much. And then also you get your money back a year earlier. But as Lee said, if you get an email from your bank or building society telling you about their wonderful new savings account, if you get any form of message, if you're looking at a savings account at your big bank or building society and you go, oh, well, that looks okay, before you press the button, before you do anything, sanity check it. Make sure that it is the best rate. And the easiest way to do that is to go to www.thisismoney.co.uk/save, where you will find our savings tables, independent Best Buy savings tables, combined by Sylvia Morris and our team, updated daily. And you know what the great thing is? We've been updating those daily all through the really awful years of savings rates when the best rates were desperately trying to hit 1%. And now there's amazing excitement. Ed Magnus is the most excited man since Liam Gallagher was young. Okay. It is just a savings frenzy going on. He doesn't do it with the same Mancunian swagger, but we think he's better than a young Liam Gallagher. So get yourself to the savings tables if you want a bit of excitement this weekend, or if you're just going to move your money and you want to check whether your bank is really offering you a good deal.
Indeed. The question, though, Lee, is Ed's excitement going to continue? You have an article on your website, What Next for Savings Rates, with expert predictions. So is the excitement to continue?
Oh, God bless the experts and actually sticking their neck on the line and making calls that are just almost impossible to make. God love them. God bless them. The general vibe that we've got from the experts in here is that easy access rates have probably got a little bit more further room to grow, and that potentially we might see a 5% easy access. At the moment, the Best Buy rate is about 4.35%. So it could be 5% before the end of the year. As Simon says, the best thing about easy access rates is you could just go and get the best easy access rate now and just move it if something better comes along. Whether people do that or not is another thing. And actually, Newcastle Building Society launched a Best Buy easy access last week. It lasted 2 days before it just got overwhelmed. So some of these like smaller challenges do fill out their coffers pretty quickly. So act fast if you want one of the top easy access. Fixed rates, the general consensus is we might be nearing the peak. But do you remember when we were trying to call the peak before? I think it's just impossible. It's just an impossible task. The general consensus that we could see sort of about 6.25% for fixed savings. So not much higher than what we're at now. Is it worth waiting to eke out a few extra quid of interest in the current environment? Hard to know. Fixed rate savings are one of those things where you've either got a lump sum of cash that you can tuck away for a few years that you don't need to do anything with, or you don't. Lots of people have been taking out 1 and 2 year fixes. There's actually been quite a lot of movement in what I would call what we've dubbed micro fix accounts as well. So 3 month, 6 month and 9 month fixes. You can get quite good rates on them, better than easy access, not quite as good as the top fixed rates, but you can, in 6 months' time, if things have changed, so it's worth considering all these things. Notice accounts as well. Notice accounts are offering, we call them a halfway house between fixed rates and easy access. They offer sort of usually 90-day terms. So you put money in it, you have to give 90 days notice to take the money out, but they offer a bit more interest. And 3 months for most people, unless you're doing something specific, is not a bad bet. But as Simon says, go and check all of these rates out. There's loads of different places to go and park your cash. Premium bonds have been boosted again. I mean, people love premium bonds. Again, I think it's all about having a blend of all of the different things. And it just depends on your circumstances and what you're doing with your savings and what you need, if you need quick access to it or you don't. There's people listening to this probably going, I don't even have any money to save. So, it all depends on your circumstances. But these are good times for savings rates at the moment. But as I keep pointing out, and as you pointed out just a minute ago, Georgie, nothing's beating inflation at the moment. But at least the gap has closed somewhat between inflation and the Best Buy savings rates.
Has indeed. That's it. Part 1.
I'm now joined by Sam North from eToro for our weekly look at what's been happening on the market. So, Sam, what's been going on?
Yeah, well, with Independence Day on Tuesday, markets started off this week pretty quiet, as expected. The jobs report, which we've literally just had, was always going to be the main focus of participants. But we did have some hawkish FOMC minutes on Wednesday, with consensus really looking at further hikes to come. Markets have come under a little bit of pressure from that. And then also on Thursday, we had a strong ADP employment number, which helped send the VIX up double digits. That strong number set us up for the non-farm payroll release, which we just had recently, as mentioned. But that, for the first time in 15 months, actually missed expectations and came in lower than expected at 209,000. Unemployment 3.6%. Average hourly earnings were up 0.4% month on month, though, which is not necessarily what the Fed want to see. But that missed expectations probably gave us a bit of a mixed report, but better than initially feared.
And what's on your radar for next week?
Well, usually the Monday and Tuesday after a US jobs report are pretty quiet, so I won't be expecting fireworks in the markets to start the week. But there are some exciting events that follow. We've got the latest US inflation number on Wednesday, as well as the UK jobs report, policy announcements from Bank of Canada and the RBNZ. So Wednesday is a busy one. Thursday brings the ECB minutes and the UK GDP number from May. And we've also got the beginning of Q2 earnings season on Friday. So usually the banks unofficially kick that off. So we've got JP Morgan, Wells Fargo and Citibank all reporting before the market open on Friday. The final note to mention is we do have Chinese inflation on the Monday. So some people will keep an eye on that. Of course, their inflation situation is very different to that in the UK at the moment. But an interesting week all in all. Thank you.
Thanks, Sam.
Cheers, Lee.
Welcome back. Talking about savings, Britons are ploughing too much money into cash savings and would be better off opting for potentially more lucrative returns elsewhere. That's according to the influential think tank, the Centre for Policy Studies. Their research shows UK retail investors, or non-professionals, control 21% of the country's assets under management. That's the lowest percentage in Europe. But what's the problem with that, Simon? When you can get pretty decent rates on your savings, why take the risk? Tell us more about this research, if you would, Simon.
So, here's the big question. Should you save or should you invest? Well, ordinarily people say to you, look, you need a long-term investment horizon, so it needs to be at least 5 years. If you need the money anytime shorter than that, then keep it in savings. Unless you are willing to take the risk that when you go to get that money, there could be substantially less of it. Now, you might get lucky and there might be substantially more of it, but over a 5-year period, you should then start to iron that out. And once you go over a longer period, then the stock market starts to, heavily and regularly outperform, statistically speaking. There's a number of studies that go back a very long way. One of the best ones is the Barclays Equity Gilt Study. There's also the Credit Suisse Yearbook. Don't dismiss that one just because it has Credit Suisse on the label. Anyway, this is all fine until you then look at a savings rate paying 5% and think, well, hang on a minute. I mean, if I can get 5% guaranteed for a year, that's pretty good. Or if I can even get 6% guaranteed for a year. Now, the problem with your 6% guaranteed for a year is you can't get that in an ISA. You can only get that in a standard savings account. So you have to take into account tax, which is why I focused on the 5% number before. And then you think, well, if I've got some money to invest, I mean, things look a bit uncertain. How likely is it that I'm going to make more than 6% and I'm going to have to take some risk over the next year? But then I can get that other rate on the savings account. So it's a matter of some debate. But the point that was being made here is that there are a lot of Britons who have large amounts of cash savings that they don't need instant or short-term access to, but that are sitting in savings accounts earning pitiful amounts of interest when they could be invested in the stock market and earning considerably more. And actually, all the evidence points to investing in the stock market being the best way of delivering long-term inflation-beating returns. And that's what you need. You need not just returns, you need inflation-beating returns. the Centre for Policy Studies warned, under normal circumstances, this neglect of the stock market would be bad for the UK, its citizens and its growth prospects. But in the current inflationary environment, the huge amount of savings left in cash is positively disastrous. Now, it's not disastrous if the alternative is that you invested it and over the course of the next year, the stock market falls and you therefore lose money and also it gets ravaged by inflation. Whereas if you put it in a savings account, it had gone up. But if you look at it over the long term, the real investment returns by asset class, okay, so on average, over the last 10 years in the UK, and this has not been a great 10 years for the UK stock market, 4.7% above inflation, real investment returns. Over 20 years, and if the last 10 years haven't looked great for the UK stock market, the last 20 years have looked really bad, 2.9% above inflation. Over the last 50 years, 4.9%. Over the last 122 years, 4.9%. Now, if you look at cash, over the last 10 years, minus 2.5%, over the last 20 years, minus 1.1%, over 50 years, 0.9%, and over 122 years, 0.6%. So in 2 out of those periods, 10 years and 20 years, you've actually lost money in real terms on cash. And in the other 2 periods, the really long ones, 50 years and 122 years, you have made an absolutely minimal return. And if you compound that over the years and look at how much of a difference that makes, it is huge. But the only thing I would say is you've got to be careful with studies like the Barclays Equity Gilt one, as good as they are, because when they look at cash, they tend to look maybe at either the base rate or the average savings rate or things like that. And if you take the best savings rate instead of the average savings rate, if you listen to what we've been saying for the last however many minutes, rather than zoning out and thinking, I wonder when they could talk about something fun. If you take those best rates, then it does make a very big difference. But you still don't beat the stock market. And even over the last 10 or 20 years, when the UK stock market has been really quite doldrumy, if that's a word, you still don't beat the stock market. But you shouldn't just be investing in the UK stock market. You should be investing in the global stock market. Once you spread it out to that, you realise that you really do fall behind quite a lot.
So I'm going back to the research that says that with the lowest number of investors, essentially, well, lowest amount of money invested in Europe, is that a cultural thing? Is there a reason that we love cash savings over investing, and the Italians I mean, I don't know, like, what do you put that down to?
So the easiest comparison is to look at the UK and the US. The US is much more of an investing market, and it's very much it's got a long history of not obsession. Well, yeah, obsession with the stock market. It's a bit like the UK and the property market. We're obsessed with the property market over here. They aren't so obsessed with the property market. I mean, they like houses, but they've got, it's such a big country. They've got many different property markets. There was this foolish belief they couldn't all fall at the same time, which largely contributed to the credit crunch. But they don't have the same obsession that we do about the property market in the same way. But we don't have the same obsession about the stock market that they do. If you then start to go to some of the European countries, it becomes quite interesting. So, for example, in Italy, lots of people invest in bonds, but they invest directly in bonds, directly in bonds, in corporate bonds, in company bonds, and things like that. This did actually blow up some years back in the middle of the Eurozone debt crisis, but that it is a form of investing that will still get you a better return than cash. I don't know why we love our cash savings accounts so much, but I do know actually from all the years of being at This Is Money that when we run polls on this and when we look into this and when we talk to readers, we do find that the bit of our readership that skews older, wealthier, has built up large sums of money in savings accounts, often has way more probably in savings than they should do. And their argument is, I don't want to take a gamble. Don't want to gamble on the stock market. But it's not a gamble. A gamble is red or black. A gamble is you get it wrong, you lose all your money. If you have a diversified portfolio, you're very unlikely to see the entire thing go to zero. And actually, quite often people will say, well, I wouldn't take a risk with my money like that. But they'll go out and they'll buy a brand new car. If you buy a brand new car, you're guaranteed to lose 30% on the price. I mean, apart from in the last couple of years where it went totally mental with some cars, but you are generally speaking guaranteed to lose 30% of the price. So the same people who would lose 30% on the price of the car and will buy a brand new car, whether they PCP it or whether they buy it outright, they're still getting the depreciation won't put their money into the stock market. And that's a weird behavioural thing.
Just one thing before we move on from this, Simon, I hear a lot about investing for inflation or investing in a time of high inflation. What should you be looking at in this sort of environment?
I just like massive outsized returns, the biggest you can get. If someone says to you, I've got something, it's really high risk.
No risk, no reward, Simon.
Well, it's probably going to get 30%, just like all in like Flynn. No, don't. Look, you need to be, the thing is the ability of a reckless investment to make such a dent in your portfolio that it massively, means you massively underperform the market, inflation, and all those other things, and it'd take you years to get back, means that you shouldn't go chasing high risk investments at a time like this. What you need to do is you need to invest in things that are right for you, your appetite for risk, reward, and so on. There are certain things, that have been doing better on the stock market in recent times. It has tended to be companies making money now, making profits right now, rather than companies make it with the hope of making profits in the future. But then this year we've seen a bit of a turnaround in that in the US, where actually there's been a bit of a tech bounce back, but there's been a relatively small number of companies there actually making a lot of the returns. I think the answer needs to be that overall you need to approach this from the perspective of diversification and making your money slowly over the long term, not trying to be too smart, not trying to time the market and all those other things, because otherwise you risk making the mistakes that blow up so badly that it would take you years to get back. And if you do want to do that stuff, do it with only a small part of your portfolio and keep the rest of it in something that is relatively safe and secure and stable.
Right. Thank you very much. And finally, there's a little known trick that can slash your tax bills in retirement and boost your income by thousands. But would you pay into your partner's pension? Lee?
Well, first of all, can I just say that feeling a bit doldrummy is my new favourite phrase after hearing Simon speak. Second of all, can I say, and finally is usually a nice fun segment. Is this your idea of a nice fun end segment? I mean, this is deep.
I work with what I'm given there, Lee. I work with what I'm given. What can I say?
This is deep for the first Friday of Wimbledon in the middle of an Ashes series. I mean, who's picked this? This is deep.
We just didn't have time for the Ashes at the end, but if you want to throw that in, Lee, because I know that you did go and enjoy it. Are you going to Wimbledon too?
Are you trying to cheer people up, Lee? I mean, England are currently 212 for 9, although Stokes has just got a half century, as we willfully chuck away the advantage that we had over the Australians in the first innings.
Well, actually, we should also point out here that we did interview Stuart Broad on This Is Money this week, talking about the Bazball for business. Definitely worth a read on This Is Money. So here we go. I've given it a nice favour, and I don't know, but he may be paying into his partner's pension.
I don't see that this is a miserable story. I mean, the way I looked at it was, what's the bad thing about paying into your partner's pension? Because if you divorce, they're going to take half yours anyway. So, that's not a cheery subject. But this is slashing tax bills in retirement and boosting your income by thousands, Lee. This is a positive end, is it not?
Oh no, I'm not saying it's not positive. I'm just saying it's
a fun and frivolous. Is that what you want?
It's quite a complex topic for the.
All right, Lee, I'll know for next time.
It's one of those things. It's almost as clear as mud when you're trying to sort of explain it. And lots of people's different circumstances, whether you're married or unmarried, and all those kind of things. But in a nutshell, actually, this can be a very good idea for people, especially people that start families, for example, and not always, but typically mum takes time off work, might miss pension contributions, and it's quite a fair way of making sure that pension is ticking over while taking paternity or maternity or paternity leave, depending on who does the heavy lifting, and it can boost your retirement by thousands. We talk about this all the time about how women typically have a third less saved in their pension pot. There's a massive gender pension gap, and this is a potential way to plug it. The thing is, this is a kind of, again, one of those things where you're probably going to want to get one-off financial advice for something like this to make sure it's something that's going to really work out in your favour, because saving in a pension is the most tax efficient way to save, but obviously you're not going to get your mitts on the money for, depending on your age, for some time, but the power of compounding, the power of that tax relief, the power of match contributions, and sometimes even doubling of contributions depending on your workplace, and depending on what your partner does, it all could work out quite nicely for you. So if you're someone that has got your retirement basically on track, you're on track. You know that you're going to have a nice, decent, comfortable retirement with the pot that you're building up. But your partner, your wife, your husband is not. Then there might not be a harm in topping up and making contributions into your partner's pension. But it takes a lot of number crunching. It takes a lot of commitment. If you're not married, that can throw up complications if you break up. A little bit more cut and dry if you are married. But it is a fairly tax efficient way to sort of top up your partner's pension. We've got examples of people that have done this in a story that we've published this week. So we've got Sarah and Ian, and he's been paying into her pension for 20 years. He started by contributing £110 a month and now pays in £160 a month. He's a police officer, and essentially he will have a good pension. Typically when you're in a job like that, you work hard, you're putting your body on the line, and you typically have a good pension payout when you come to retirement age, of which he's close to hitting. She was a stay-at-home parent, but stay-at-home parent to their 7 children, and built up no pension savings of her own. So in that circumstance, you can see why and how it makes sense. And there's other examples of this as well. For example, you might be self-employed. Self-employed people have this real habit of not paying enough into their SIP, or having a SIP. I mean, I think I've mentioned my best friend Jordan on this podcast before. He's been self-employed since we left school, and the amount of times I tell him to open a SIP, and the shutters has come down, and he's like, yeah, mate, I'll look into it. Yeah, do it. And just doesn't do it. But it can, if one of you self-employed, again, it might be not a bad idea to help pay into a SIP if you have a SIP. Again, I think this is one of these things that is, me personally speaking, if I was tempted to pay into my partner's pension, I would be looking to get some proper independent one-off financial advice to make sure this is something that's going to be beneficial to the both of us. And to your partner. That is the long and short of it. Without going into any more depth, I think that probably just about covers it. But actually, do you know what, Georgie? I think that a lot of people don't even know about this and wouldn't even consider it, and wouldn't even consider it as an option. So it's definitely worth mentioning this in the last segment, because if it's a way of helping close that gender gap, and it's a way to save tax efficiently, and for you both to have a nice retirement pot when you come to retire, whether you're still together or not, I still think that's a pretty nice thing to do, and a pretty good, noble way to be putting your money away.
There's quite a quirky thing here with the story as well, and the suggestion, which may make you need to read it twice, because I needed to read it twice. Go, hang on a minute. When this suggestion was made, which is that the lower paid partner pays into the higher paid partner's pension rather than their own, which you're like, I thought the higher paid partner was meant to be helping the lower paid partner out. But the higher paid partner, if they're a higher rate taxpayer, gets more tax relief. So if rather than the lower paid partner paying into their own pension and getting 25% basic rate tax relief, they pay into their higher earning partner's pension, they then get higher rate tax relief, which is much greater. And as a couple, they get better tax relief. But you do have to remember that there is something to be said for each having your own pension pots. There is that issue where, God forbid, there's a split or something like that. This might become more complicated to unpick, and so on. And actually, sometimes it's just better to have, your own income as well. So that's what people need to think about. But that is an interesting quirk of this idea of because normally all of these suggestions that you get are the other way around. Use the lower paid person, and this way around, it's like, no, put it into the higher paid person's pension.
Makes sense. Right, that's it. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team, anything you'd like them to look into, Simon.
You can email us at editor@thisismoney.co.uk, or you can tweet us at thisismoney, or you can come to thisismoney.co.uk/podcast to find all podcasts past and join in the debate in reader comments.
Marvellous. And if you like this podcast, why not rate us wherever you found us? It helps other people find us too.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.